Can you explain the structural deficiencies you found at Tungsten and what are you doing to correct them?
Indeed, as you can imagine, any new CEO arriving at post needs to figure out exactly what he or she has there. And so we undertook a very systematic self-assessment process to understand the coherence of our strategy, the resources and plans that we had supporting it, gaps and myths that we may have been living, and of course where our hidden opportunities lie. And what we found is we had several structural deficiencies to deal with. Specifically, we had a very bespoke approach to our business, from the way we contracted to the way we priced to, in fact, the way we went about implementing things. Secondly, we had some organizational structure that institutionalized functional divides, a lack of accountability or end-to-end ownership. We needed to address that. And then thirdly, we had a host of legacy technology. You know, our predecessor company was the pioneer in electronic invoicing. And when they built what they did, there wasn't the software that you can buy off the shelf today. So while our technology stack processes invoices very well, it doesn't do so exceedingly efficiently. So in the first, we spent a lot of time addressing the contractual constraints that we had. We did that by standardizing our pricing and by standardizing our approaches to interact with customers so that firstly, we're an easier business to deal with. Secondly, we put our field force in the position to make decisions that allows us to better scale. Specifically, we found contracts that allowed for auto renewals into perpetuity. So even as our buyer clients continue to grow with us, processing more invoices, doing so in more countries for tens of thousands of more suppliers, they would renew for 2 and 3 and 4 year periods at the same price they had been, 3 or 4 years earlier. So we began to change that, and we would sit with our clients and price our product to the value that they were inuring. And that's been a very positive thing in terms of economics within our business. With respect to the organization, we did 2 things. One is we took away the buyer and supplier pillars that we had embedded in the business and instead created something of a factory mindset. And what I mean by that is we really brought all of the buckets of activity involved in onboarding a supplier under one executive. So the entire process from a release of a name to the engagement on our network was controlled inside of this factory. It made for more effective and efficient delivery and a more timely delivery of that onboarding activity. And with respect to the technology stack, we're in the midst of a very fundamental migration of our core production systems from a monolithic approach to a much more modular, flexible one. And in doing that, we believe it takes us a long way towards the overall objective of decoupling our cost base from our revenues. That is, introducing operating leverage into this business so that indeed we can grow it profitably.
Can you explain what you're doing in Tungsten to increase the volume of invoice financing?
Yeah, I appreciate the opportunity because I would want the markets to understand that in no way has Tungsten stepped back from its interest in growing a very disruptive supply chain financing business, just the opposite. We're doubling up our efforts in that regard, and we're doing it in the manner that you've just described and others, which I'll explain. Ours really is, at Tungsten, a game of 2 halves. So the first half is all about these operational efficiencies that are going to allow us to elevate the network effect among our existing members in a very meaningful way with higher velocity. The second half is about leveraging that unique network in order to grow financing opportunities. We have lots of them, but the approach that Tungsten had been taking to financing those receivables narrowed that opportunity from big numbers to small. It did because it took a ultimately conservative approach to the subject matter. We would finance receivables that had been approved to pay with a payment due date attached. It was really tail risk. But we took this large numbers pool and shrunk it down to a very small set that actually fulfilled the approved to pay with payment due date criteria. So what we're now going to do in our disruptive financing business is really three things. One is begin to take some risk. So we will take supplier risk by financing their receivables even without that payment due date and without changing a bank account. We're prepared to do that because we are uniquely positioned to mitigate that risk by the use of our own spend data. So we know a whole lot about that supplier that a conventional provider of capital may not know. We know how long they've been a vendor to the particular buyer whose receivable they want to finance. We know the goods or services that they've been providing. We know if they've been a vendor for 10 years or for 10 days. We know whether the size and price of that particular transaction is on baseline or above or below. The point being is we have all of this data that gives us insights from an underwriting perspective that others may not have. Armed with that, we feel very comfortable that we can manage that risk and in so doing expand our opportunity. The second thing that we're going to do to grow our supply chain financing business is we're going to use technology. We're a growing technology company. And right now, with our one product, Tungsten Early Payment, vendors could come to the Tungsten portal and with a click of a key, secure financing in the same day. Well, we're going to use that same real estate, that technical connection, to provide other financing capabilities. And we can do that to generate revenues through the transaction itself or to provide capabilities to other players in the market in order to mitigate their operational costs of fulfilling that transaction. So our technology is going to play a big role moving forward. And then lastly, is we look to work sort of in the vein I was just describing with partners. So we think we have data and technology that will better inform and provide a better product for other organizations already in this business. So we look to expand by leveraging strategic relationships in a way that we hadn't been before.